Well, with the extreme volatility in the stock markets, millions of investors have shifted their money into the perceived safety of bonds. But has that created a bond bubble? And if so, is it ready to burst? Joining us today to discuss this is Lou Day, managing partner with NS Capital in Stamford, and Todd Peters. He is chairman of investments, also with NS Capital. Good to have you both here.
Thank you. Great to be
here.
All
right, Lou, let's start with you. And first of all, for the individual investor out there that might not really know what the true definition of a bond bubble is, what is it?
Well, I think the definition is of a bubble, and a bubble really does not match up with bond as an asset class, and I'll tell you why. What happens with a bubble is this: there's an asset class that gets euphoric, then there are speculators that come in, okay, to build on that euphoria. And what they do is they actually speculate and they build up short-term for short-term gains. I mean, and then what happens is all prices rise, and then of course, they fall, and that's a bubble. So usually, there's a tulip bubble, there was an internet bubble.
Sure.
So when you use the word bubble relationship to bonds, it's probably not correct. There is not a bond bubble. If I want to use the word bubble with bonds, I would say there's a fear bubble.
Okay, but would it be safe to say, Todd, that you think too many people have invested in bonds at this stage of the game, have too much of their portfolios, 401ks, IRAs, in bonds at this stage?
Well, I think, as Lou was mentioning, fear has come into play, and so a lot of people are sitting there saying, you know what, bonds are safe. They've kind of equated those two together, and there are times that bonds are not as safe as people would believe them to be, and when rates start going back up, bonds are going to be affected, and some are going to be affected much more than others. And so it's one of those really key considerations that you may think you have built a safety into your portfolio. You may have actually walked into something that's going to give you a reaction that you didn't expect.
Yeah, let's talk a little bit about that relationship between interest rates and bonds. For folks at home who may not understand, how does that work? And in anticipation of interest rates perhaps really starting to climb, and steeply, how would that affect bonds?
Sure. Interest rates and bond prices actually have an inverse relationship. So as interest rates go up, the price of the bond will go down. And there is a term in the industry called duration. And basically it's a sensitivity measure. And it's the sensitivity measure, whereas if interest rates go up 1%, how much will your bond go down? And if you see a number by a duration, and duration and maturity are not exactly the same, there are some subtle differences. But if you see a bond with a duration of 7, which is what kind of the 10-year Treasury has today, then when you have a corresponding increase in interest rates of 1%, you're going to see a 7% decline in the value of that bond. And that's kind of the potential impact, and that's what you have to watch out for as interest rates do make a move up. Okay,
and many people, a recent article about the number of people pouring into tips in anticipation of inflation on the rise. Does that make sense? I mean, are all bonds created equally?
Well, all bonds are created equally as it relates to interest rates rising and falling. Okay, it depends on the creditworthiness of the bond and so on and so forth. But right now the bet is it deflation or is it inflation? And with the TIPS auction that we just had, theoretically, quote unquote, the smart money, which we all know has not been as smart in recent years as we thought it was. But the bet right now is being made that there's a much greater possibility of inflation than there is of deflation.
I mean, we're seeing all the signs as we look at commodity prices rising so quickly. It seems to make sense. But what about quantitative easing and that relationship with the possibility that we could really see bonds drop?
Well, with regards to that, I mean, you're seeing the marketplace trying to anticipate the moves of the government and the Federal Reserve as kind of a surrogate for the government movements. And I think that's people are discussing it a lot. It's in the news. It's always a front page type of topic. And so what you see with the markets is the markets are always trying to be anticipating as to what's going to then actually follow through. And so, I think that's why you're seeing you saw the TIPS auction that we just mentioned go into a negative yield, actually. And it's because they think that this time the stimulus or the quantitative easing is going to officially take hold, and it is going to create that platform that we're going to build out of. So,
in other words, it will this time around, it will stimulate the economy, which means all the more of just teeing up inflation at that point, right?
it's something to very much be aware of and to be watchful of.
All right, you're going to stay with us. We're going to take a break, talk a little bit about that fear and greed that we were referring to a moment ago, and we'll be back with more 12 on the Money after the break.